The trading floor was silent. For the first time anyone could remember, 745 7th Avenue stood empty on a Monday morning. The screens that should have been alive with numbers showed nothing. The phones that should have been ringing sat dead on desks still cluttered with coffee cups and family photographs. Outside, television crews filmed employees emerging with cardboard boxes, their faces blank with shock. It was 9:47 a.m. on September 15, 2008, and Lehman Brothers, a firm that had survived the Civil War, 2 world wars and the Great Depression, no longer existed. The silence itself was unnatural. For decades, this floor had been alive with noise, the constant hum of electronic tickers, the shouted orders of traders executing million-dollar positions, the buzz of hundreds of conversations happening simultaneously as money moved across continents. Veteran traders described it as a kind of music, a symphony of commerce that never stopped. Some said they could tell how the markets were moving just by the pitch and volume of the floor's ambient sound. Now there was nothing, just the hollow echo of footsteps as security guards escorted the last remaining employees out of the building. The air conditioning still ran, its mechanical whisper the only sound in a space designed for thousands. Coffee sat cold in abandoned mugs. Half-eaten bagels hardened on paper plates, computer monitors displayed frozen screens, the last prices from Friday afternoon locked in digital amber. Maria Chen, a junior analyst who had joined Lehman just 18 months earlier, stood at her desk on the 31st floor, staring at the cardboard box she'd been told to pack. She was 24 years old. Lehman had been her dream job, the culmination of 4 years at Princeton and 2 brutal summers of internships where she'd worked 100-hour weeks to prove she belonged. She had believed she was building a career at an institution that would last forever. The desk held the detritus of her short career. There was the Bloomberg terminal she'd spent hundreds of hours studying, learning to read market signals and track bond prices. The 3 computer monitors that had displayed spreadsheets with millions of data points. The Princeton coffee mug her roommates had given her as a going-away present when she moved to New York. A small succulent plant that had somehow survived 18 months of fluorescent lighting and irregular watering. Post-it notes covered with her handwriting, model assumptions, phone numbers, reminders for meetings that would never happen. She remembered her first day, the orientation session where HR executives spoke about Lehman's proud history, its survival through countless crises, its commitment to excellence. The tour of the trading floor where the noise and energy had been overwhelming. The moment she sat down at this desk, her desk, and felt like she had made it, had proven herself worthy of a place in the most competitive industry on earth. Her manager, a vice president named David Kowalski, had taken her to lunch that first week. He'd ordered the most expensive items on the menu and told her that at Lehman they didn't settle for second best in anything. "You're going to work harder than you've ever worked," he said. "But you'll learn more in 1 year here than you would in 5 years anywhere else. This is the big leagues." She had believed him. She had worked 80, 90, sometimes 100-hour weeks. She had sacrificed weekends, holidays, relationships. She had built financial models until her vision blurred, had practiced presentations until she could deliver them flawlessly under pressure. She had done everything asked of her and more. And now David Kowalski was gone, fired 3 months ago during a previous round of layoffs. The vice president who had promised her a career had himself become expendable. And now Maria was packing her desk, joining him in the ranks of the unemployed. She picked up the framed photograph of her parents at her graduation. They had emigrated from Taiwan with nothing. They had worked in restaurants, saved every dollar, put her through college. When she'd called them Friday night to explain that Lehman was collapsing, that her job was gone, her mother had been silent for a long time. Then she'd said simply, "You will survive this. We survived worse. Maria placed the photograph in the box. Then she looked around at the empty floor, at the hundreds of vacant desks, and wondered how many others were having similar conversations with their families. How many dreams were ending today? 63 hours earlier, on Friday evening, the most powerful men in American finance had gathered in a fortress-like building at 33 Liberty Street in Lower Manhattan. Treasury Secretary Henry Paulson stood before them with a message that would change everything. The government would not save Lehman Brothers. Find a solution yourselves or watch it die. The question that would haunt the next decade had already formed. In a system where everyone is connected to everyone else, where billions of dollars move between institutions every second, where a single firm's collapse can freeze credit markets across the entire planet, who decides which failures are acceptable? Who determines when intervention becomes moral hazard and when refusal becomes catastrophe? This is the story of how that question was answered over one impossible weekend, and how the answer broke the world. Before we continue, I want to ask you something. This story matters, and so does your support. Take a moment to like this video and subscribe to the channel. It genuinely makes a difference. And I'm curious, where in the world are you watching from today? Drop a comment and let me know. I love hearing from you. To understand how Lehman Brothers died, you have to understand what it was before the weekend. Not the modern investment bank that collapsed, but the firm it had been for a century and a half before that moment arrived. In 1844, a 23-year-old cattle merchant's son named Henry Lehman stepped off a ship from Bavaria and made his way to Montgomery, Alabama. He opened a dry goods store. He sold fabric, tools, anything settlers needed. He was one of thousands of German Jewish immigrants trying to build something in America. He had no reason to believe his name would one day represent anything beyond that small shop. The journey from Bavaria to Alabama had taken 6 weeks. Henry Lehman spent most of that time below deck in steerage, crammed with other immigrants in conditions that would be considered inhumane by any modern standard. The air was thick with the smell of unwashed bodies, vomit, and the ever-present dampness that seeped through the wooden hull. People died on these voyages, from disease, from malnutrition, from simple despair. The ship, a 3-masted merchant vessel converted for passenger transport, carried over 400 immigrants in conditions designed for perhaps half that number. Families huddled together on narrow wooden bunks stacked 3 high. Privacy was non-existent. The ship's sanitation consisted of a few buckets that had to be emptied by hand. When storms hit, and they hit frequently crossing the Atlantic in winter, the hatches would be sealed, trapping everyone below deck in darkness, broken only by the faint light of oil lamps that swung wildly with each wave. Henry kept a journal during the voyage, small leather-bound pages filled with observations written in cramped German script. He described the Jewish families from other Bavarian villages, the Irish peasants fleeing the Great Famine, the German craftsmen seeking new markets for their trades. He wrote about a young woman who gave birth during a storm, the baby's first cries barely audible over the howling wind and creaking timbers. He noted the deaths, an elderly man in the 2nd week, a child in the 4th, and the somber ceremonies when bodies were committed to the sea, wrapped in canvas, weighted with whatever metal could be spared. Henry survived by keeping his eyes forward. He had grown up in Rimpar, a small village near Würzburg. His father had been a cattle merchant, respectable but not wealthy. There were limited opportunities for younger sons in Bavaria's rigid social structure. America represented possibility. The stories that filtered back to Germany spoke of a place where a man's origins mattered less than his industry, where fortunes could be built through hard work and cleverness. When Henry finally set foot on American soil, he carried everything he owned in a single leather trunk. He had $40 in cash, a rudimentary command of English learned from a grammar book during the voyage, and an introduction to a distant relative in Montgomery who might help him establish himself. Montgomery in 1844 was a frontier town rapidly transforming into a commercial center. Cotton was king, and the Alabama River provided transportation to Mobile and the Gulf of Mexico. Henry's small shop on Commerce Street served the practical needs of a growing population: fabric for clothing, tools for farming, household goods for settlers, establishing homes in what was still in many ways wilderness. But Alabama in the 1840s ran on cotton, and when farmers couldn't pay in cash, Henry accepted cotton as payment. He discovered he could sell that cotton to textile mills up north for more than the goods he'd traded. By 1847, his brother Emmanuel had joined him. By 1850, Mayer arrived. The store's sign changed: Lehman Brothers. The brothers complemented each other perfectly. Henry had the vision, the ability to see opportunities others missed. Emmanuel had the discipline, the systematic mind that turned opportunities into sustainable business practices. Mayer brought charm and salesmanship, the ability to build relationships that transformed transactions into partnerships. They developed a system. Farmers would bring cotton to the Lehman warehouse. The brothers would assess quality, assign a value, and issue credit against future crops. They would aggregate cotton from dozens of small farmers, creating larger lots that could be sold more efficiently to textile manufacturers. They charged a commission on each transaction, but more importantly, they became indispensable intermediaries in a complex supply chain. The business model required trust. Farmers had to believe that the Lehmans would fairly value their cotton and pay promptly. Manufacturers had to believe that the cotton they purchased would be of consistent quality and delivered as promised. The brothers built this trust through transparency, through honoring every commitment, through being present in the community. They stopped being shopkeepers. They became cotton brokers, middlemen between southern plantations and northern mills. By 1858, they had opened an office in New York City. They were supposed to remain regional traders, small operators in a vast commodity market. The Civil War should have destroyed them. Montgomery was Confederate territory, their business built on slave labor cotton. The moral complexity of this position cannot be avoided. The Lehman Brothers built their fortune on a commodity produced by enslaved people. They did not own slaves themselves. Their business was brokerage, not production, but they profited directly from slavery's existence. When the Civil War erupted, they faced an impossible choice: support the Confederacy that sustained their business, or preserve their New York connections that represented their future. The historical record suggests they attempted to maintain neutrality for as long as possible, continuing to operate in both Montgomery and New York, even as the war made such dual allegiance increasingly untenable. Emmanuel eventually left Montgomery to run the New York office full-time. Henry and Mayer remained in Alabama, navigating the complexities of operating a business in Confederate territory while maintaining relationships with northern textile mills that were now, technically, the enemy. But the New York office survived. And after the war, the Lehmans rebuilt. They shifted from cotton to commodities, then to finance itself. By 1906, they were partnering with Goldman Sachs on securities underwriting. They were becoming what Henry Lehman could never have imagined, a Wall Street institution. The transformation was gradual but deliberate. In the decades after the Civil War, American commerce was industrializing. Railroads needed capital to expand across the continent. Manufacturing companies required funding to build factories. Mining operations sought investors to develop resources. The country's financial infrastructure was primitive compared to Europe, and there were enormous opportunities for institutions that could connect American businesses with capital sources. Lehman Brothers moved methodically into this space. They began underwriting railroad bonds in the 1870s. They financed commodity traders who needed credit to purchase agricultural goods before selling them to processors. They provided working capital to manufacturers expanding production capacity. Each step took them further from their origins as commodity brokers and deeper into the world of finance itself. By the turn of the 20th century, Lehman Brothers had become one of several Jewish-founded firms that dominated certain segments of Wall Street. While the old-line Protestant banks like J.P. Morgan and Brown Brothers handled the most prestigious clients, firms like Lehman, Goldman Sachs, and Kuhn Loeb carved out profitable niches in sectors the establishment firms considered beneath them: retail, entertainment, commodities. This created a firm culture defined by both ambition and insecurity. Lehman's partners knew they were capable of competing with anyone on Wall Street, but they also knew they would never be fully accepted by the industry's social elite. They compensated by being more aggressive, more innovative, more willing to take risks that traditional banks avoided. The firm that emerged over the next century was defined by one characteristic above all others: survival. When the market crashed in 1929, Lehman survived. When competitors merged or vanished during the Depression, Lehman endured. The name came to mean something specific on Wall Street: not the flashiest firm, not the most aggressive, but reliable, steady, built to last. Robert "Bobby" Lehman, who led the firm from 1925 until his death in 1969, embodied this philosophy. He collected art, maintained relationships with blue-chip corporate clients, and insisted that Lehman Brothers would never chase short-term profits at the expense of long-term reputation. Under his leadership, the firm navigated the Depression, financed American industry during World War II, and established itself as a trusted advisor to generations of corporate executives. That identity shaped everything about Lehman's culture through the mid-20th century: conservative risk management, long-term client relationships, the understanding that markets moved in cycles and that survival meant respecting those cycles. The partners who ran Lehman had lived through catastrophe. They managed the firm like men who knew what could happen when caution disappeared. The partnership structure reinforced this conservatism. Partners had unlimited personal liability for the firm's debts. If Lehman failed, they would lose not just their jobs but potentially their personal wealth. This created powerful incentives to avoid excessive risk. Every major decision was evaluated not just for its profit potential, but for its downside consequences. Partners would gather in wood-paneled conference rooms and debate risks for hours. They would dissect proposals, searching for weaknesses. The prevailing attitude was skeptical. Prove that this deal makes sense. Prove that we understand the risks. Prove that we can survive if our assumptions are wrong. This culture could be frustrating for younger bankers who wanted to move quickly, but it had allowed Lehman to survive when others didn't. But cultures don't last forever. And by the 1980s, the firm that had survived every previous crisis was about to be consumed by one it created itself. Wall Street in the 1980s was transforming. Deregulation was eroding the barriers that had separated different types of financial institutions since the Depression. Technology was enabling new trading strategies and new products. Compensation structures were shifting from partnership shares to annual bonuses, changing the incentives that drove decision-making. In 1984, American Express acquired Lehman Brothers. The partnership became a division of a corporate conglomerate. The culture of careful risk management began to erode. Traders who wanted to make aggressive bets chafed under corporate ownership. By 1994, American Express spun Lehman back out as an independent public company. The American Express years had been turbulent. The credit card company had acquired Lehman believing that combining financial services under one corporate umbrella would create synergies and cross-selling opportunities. Instead, it created cultural conflict. Lehman's bankers resented answering to corporate executives who didn't understand investment banking. American Express managers were frustrated by Lehman's expensive compensation packages and unpredictable earnings. The merger also eliminated Lehman's partnership structure, replacing it with corporate hierarchy. Partners who had previously shared collective responsibility for the firm's risks became employees focused on their division's performance. The long-term perspective that had defined Lehman's culture gave way to quarterly earnings pressure. Decisions that might have been rejected by cautious partners were approved by managers optimizing for short-term results. Internal battles became vicious. Louis Glucksmann, who led Lehman's trading operations, fought for control against Pete Peterson, who represented the traditional investment banking culture. Glucksmann ultimately won, but his victory accelerated the firm's cultural transformation from advisor to trader, from relationship-focused to transaction-focused. When American Express finally spun Lehman out in 1994, the firm that re-emerged was fundamentally different from the conservative partnership that had been acquired a decade earlier. The man chosen to lead this newly independent Lehman was Richard Fuld. He had joined the firm in 1969 as a commercial paper trader. He had spent 25 years rising through the ranks. He was 48 years old when he became CEO, and he intended to prove that Lehman could compete with anyone on Wall Street. Richard Severin Fuld Jr. had grown up in Westchester County, New York. His father had worked in textiles, an industry connection to Lehman's origins that was purely coincidental. Dick, as he was known to those who had worked with him for decades, attended the University of Colorado and then received an MBA from New York University's Stern School of Business. He was not an Ivy League pedigree, not old money, not someone who had grown up expecting to run a Wall Street firm. This background shaped his management style. He had worked his way up through the trading floor, not through client-facing investment banking. He understood risk positions and market dynamics better than corporate relationships. He believed that profits came from being smarter and tougher than the competition, from making bigger bets when you had conviction. Fuld was known for two things: intensity and loyalty. He worked out at 4:30 in the morning and expected his senior team to do the same. He inspired fierce devotion among Lehman lifers and intimidation among everyone else. His nickname, never used to his face, was the Gorilla. He believed Lehman's independence was sacred. The firm had been swallowed once by American Express. Under his leadership, that would never happen again. He conducted morning meetings that were famously brutal. Executives would present their division's performance, and Fuld would dissect every number, every decision, every assumption. He wanted to know not just what had happened, but why, and what was being done to improve. People who couldn't defend their positions found themselves marginalized or pushed out. Those who could match his intensity and deliver results were rewarded lavishly. This created a culture of fear mixed with opportunity. If you could survive Fuld's scrutiny, if you could produce the revenues he demanded, you would be compensated extraordinarily well and given substantial autonomy. But failure was not tolerated. Lehman under Fuld was not a place for people who needed reassurance or mentorship. It was a place for aggressive self-starters who believed they were the best and wanted to prove it. The loyalty cut both ways. Fuld was fiercely protective of Lehman lifers, the people who had stayed with the firm through the American Express years and the rebuilding after the spin-off. He promoted from within whenever possible. He created a culture where longevity was valued, where 20-year veterans were treated as family. This inspired genuine devotion. People who worked for Fuld often spoke of him with an almost reverent respect, describing him as a leader who would go to war for his people. But this loyalty also created blind spots. Fuld surrounded himself with people who had risen through Lehman's system, who shared his worldview, who believed as intensely as he did in the firm's exceptional character. Dissenting voices were often outside this inner circle, and they found it difficult to challenge the prevailing assumptions. The Wall Street Fuld inherited in 1994 was transforming. Traditional investment banking, advising clients on mergers, underwriting stock offerings, generated steady but limited profits. The real money was in trading, not trading on behalf of clients but proprietary trading, using the firm's own capital to bet on market movements. Lehman under Fuld pivoted hard toward this model. The shift was driven by mathematics. Advisory fees from mergers and acquisitions were substantial but episodic. A firm might earn $20 million advising on a major transaction, but those transactions happened irregularly. Underwriting fees from stock and bond offerings were more consistent but still limited by the number of companies going public or issuing debt. Trading, by contrast, offered theoretically unlimited returns. If you had $10 billion in capital and you could generate a 10% return through proprietary trading, that was $1 billion in profit. And if you leveraged that capital, borrowing $30 for every dollar of equity, the potential returns multiplied. This was the model that Goldman Sachs had used to become Wall Street's most profitable firm. Fuld was determined that Lehman would follow the same path. And there was one market in the early 2000s that seemed to offer unlimited opportunity: real estate. American home prices had been rising steadily since the mid-1990s. By 2003, the increase was accelerating, and Wall Street had discovered a way to transform mortgages, traditionally boring, safe, local bank business, into tradable securities that could be bought and sold globally. Take thousands of individual mortgages, bundle them together, slice the bundle into tranches with different risk levels, get rating agencies to certify the top tranches as safe as government bonds, then sell these mortgage-backed securities to investors worldwide. The financial engineering behind these securities was genuinely sophisticated. Mathematicians with PhDs worked in specialized groups, creating models that predicted default rates under various economic scenarios. The logic seemed sound. Even if some individual mortgages in a pool defaulted, the diversification across thousands of borrowers in different geographic areas meant the overall pool would remain stable. Senior tranches would be protected by junior tranches that would absorb the first losses. The rating agencies validated these models. Moody's and Standard & Poor's employed their own analysts who reviewed the underlying assumptions and confirmed that the top-rated tranches deserved AAA ratings, the same rating given to U.S. Treasury bonds. This created a kind of alchemy, transformed thousands of individual mortgages of varying quality into securities that pension funds and insurance companies, restricted to investing only in the safest assets, could legally purchase. The demand for these securities was enormous. Investors around the world were searching for yield in an era of low interest rates. Mortgage-backed securities offered higher returns than government bonds while supposedly carrying similar risk. Money poured into the market. The model seemed perfect. Housing prices only went up. Even if some borrowers defaulted, the diversity of the pool protected investors, and the rating agencies, Moody's, Standard & Poor's, Fitch, blessed the securities with the AA ratings. Risk-free returns. The perpetual money machine. Lehman Brothers under Richard Fuld decided to dominate this market. In 2004, the firm acquired BNC Mortgage, a subprime lender. In 2007, it acquired Aurora Loan Services. It wasn't enough to create mortgage-backed securities from loans other companies originated. Lehman would originate the loans itself, package them into securities, and hold vast quantities of those securities on its own balance sheet as investments. The strategy was called vertical integration. By controlling every step of the process, from originating mortgages to packaging them into securities to trading those securities, Lehman could capture profits at each stage. When a borrower took out a mortgage from BNC Mortgage, Lehman earned an origination fee. When that mortgage was packaged into a security, Lehman earned a securitization fee. When the security was sold to investors, Lehman earned a trading commission. And if Lehman retained some of the securities as investments, the firm would earn the interest payments from the underlying mortgages. The model required enormous scale. To generate the profits Fuld demanded, Lehman needed to originate billions of dollars in mortgages annually. This created pressure to lower lending standards to approve borrowers who might not have qualified under traditional criteria. Subprime lending, making loans to borrowers with poor credit, unstable income, or minimal down payments, became a major profit driver. Mike Gelband, Lehman's head of fixed income, raised concerns as early as 2006. He warned that the firm's real estate exposure was becoming dangerously concentrated, that housing prices couldn't rise forever, that the mortgages being originated were of questionable quality. He presented data to Fuld and the executive committee showing deteriorating loan performance and rising default rates. Fuld listened, but he didn't act. The business was too profitable. In 2005 and 2006, Lehman's revenues reached record levels. The firm's stock price climbed. Compensation packages for senior executives swelled to levels that would have seemed obscene a generation earlier. Gelband's warnings seemed overly cautious, the concerns of a risk manager who didn't understand the new realities of the market. By the end of 2007, Lehman Brothers held approximately $85 billion in mortgage-related assets. It had $60 billion in commercial real estate exposure, and it was operating with a leverage ratio of 37-1. For every dollar of actual capital the firm possessed, it had borrowed $30 and deployed them into investments. To put this in perspective, if Lehman's investments declined in value by just 3.3%, the firm's entire equity capital would be wiped out. The margin for error was extraordinarily thin. Lehman was operating like a hedge fund, making massive leveraged bets, but it was also a systemically important financial institution with thousands of employees and countless counterparties who depended on its stability. This was the firm Richard Fuld had built, a firm that bore almost no resemblance to the conservative cotton brokers who had founded it, or to the careful partners who had navigated the Depression. Lehman in 2007 was a leveraged bet on the perpetual rise of American real estate. And that bet was about to fail. The first crack appeared in February 2007, when HSBC Holdings announced major losses in its U.S. subprime mortgage portfolio. Then in August 2007, BNP Paribas froze 3 investment funds because it could no longer value the mortgage-backed securities they held. Credit markets seized. The business model that had seemed invincible 6 months earlier suddenly looked fragile. The BNP Paribas announcement was particularly alarming because it revealed a problem that would plague the entire crisis. Price discovery had failed. Markets function when buyers and sellers can agree on prices. But the mortgage-backed securities had become so complex, so opaque, that no one could determine what they were actually worth. The models that had been used to create them assumed active, liquid markets where securities could be traded based on objective valuations. When those markets disappeared, the entire structure collapsed. Lehman's stock, which had hit an all-time high of $86.18 per share in February 2007, began to fall. But inside the firm, senior management insisted this was temporary. A correction, not a crisis. Housing prices would stabilize, the securities would recover value, Lehman would be fine. This belief was not entirely irrational. In late 2007, the US had experienced housing corrections before, without triggering financial catastrophes. The savings and loan crisis of the late 1980s had been severe but contained. The 2001 recession had been mild. There was reason to believe that the Federal Reserve would lower interest rates, that government policy would support the housing market, that the worst-case scenarios wouldn't materialize. But beneath this rational analysis lay something more psychological. Lehman's senior executives had spent years building the firm's real estate business. They had staked their reputations on this strategy. Admitting that the entire model was flawed would have required acknowledging that they had made catastrophic errors in judgment. The psychological barriers to such admission were immense. Instead, they looked for evidence that confirmed their existing beliefs. When housing prices stabilized briefly in early 2008, this was interpreted as vindication. When some mortgage-backed securities traded at higher prices, this was seen as proof that the market had overreacted. Contradictory evidence was dismissed as temporary or anomalous. Richard Fuld believed this completely. In April 2008, even as Bear Stearns collapsed and had to be rescued by JP Morgan Chase with Federal Reserve support, Fuld told investors that Lehman had never been stronger. The firm raised $4 billion in new capital in March. It raised another $6 billion in June. Fuld was certain that if Lehman could just survive the short-term panic, the firm would emerge vindicated. The capital raises were desperate measures disguised as strength. Lehman was bleeding money as its mortgage-backed securities declined in value. The firm needed fresh capital to absorb losses and maintain its leverage ratio within acceptable ranges. But raising capital in the middle of a crisis meant accepting dilutive terms from investors who understood they had leverage. The Korea Development Bank negotiations exemplified this dynamic. The South Korean Sovereign Wealth Fund expressed interest in making a major investment in Lehman, potentially acquiring a significant ownership stake. For months in the summer of 2008, Lehman's advisors negotiated terms, but the Koreans kept demanding better prices as Lehman's stock price fell. By September, they were offering to invest only if they could acquire Lehman at a valuation that Fuld considered insulting, a price that would wipe out existing shareholders and represent a complete surrender of control. Fuld refused. He believed Lehman was worth more. He believed the market would eventually recognize the firm's value. This faith, admirable in its way, prevented him from accepting deals that might have saved the company, but the losses kept coming. In June 2008, Lehman announced a quarterly loss of $2.8 billion, its first loss since going public in 1994. The stock fell, confidence ebbed, and behind the scenes, Lehman was using accounting techniques that made its financial position look stronger than it actually was. The technique was called Repo 105. In a standard repurchase agreement, a firm temporarily sells assets with an agreement to buy them back later, essentially a short-term loan using securities as collateral. But Lehman was classifying certain of these transactions as sales rather than loans, allowing it to remove as much as $50 billion in assets from its balance sheet at the end of each quarter. The assets would disappear for reporting purposes, making Lehman's leverage appear lower than it was, then reappear after the financial statements were filed. Erin Callan, who served as Lehman's chief financial officer in the first half of 2008, became the public face of the firm's financial reporting during this period. Young, articulate, and confident, she appeared on CNBC and Bloomberg television defending Lehman's position, assuring investors that the firm had adequate capital and liquidity. Behind the scenes, she was working with Lehman's financial controllers to manage the quarterly numbers, using every available accounting technique to present the firm in the best possible light. Callan later said she believed the techniques being used were legal and standard industry practice. And they were legal. Repo 105 exploited a loophole in accounting standards that treated certain repurchase agreements as sales rather than financing. But legal and ethical are not synonymous. Investors looking at Lehman's public filings had no idea that the firm's reported leverage ratio was substantially lower than its actual ratio, that tens of billions in assets were being temporarily removed from the balance sheet at quarter end. This was legal. Lehman's auditor, Ernst & Young, knew about it. But it was deceptive. Investors looking at Lehman's quarterly reports had no idea that the firm's actual leverage was far worse than the numbers suggested. By September 2008, Lehman was running out of options. Fuld had been in talks with Korea Development Bank about a major investment, but those negotiations collapsed on September 9th. The firm announced another massive loss. The stock fell 45% in a single day, and the only realistic path forward was a sale to a larger bank. The collapse of the Korea Development Bank talks was devastating. Lehman had spent months cultivating this relationship, presenting it to investors and analysts as evidence that the firm had strategic options. When the Koreans walked away, citing concerns about Lehman's asset quality and the deteriorating market conditions, it signaled to everyone watching that Lehman's problems might be unsolvable. Hedge funds that had accounts at Lehman began withdrawing their cash. Counterparties demanded more collateral for existing trades. The firm's liquidity, its ability to access cash to meet immediate obligations, was eroding rapidly. Lehman was entering what bankers call a death spiral, where declining confidence leads to withdrawals, which weaken the institution further, which causes more confidence to evaporate. Two potential buyers emerged, Bank of America and Barclays, the British bank. Both began conducting due diligence, examining Lehman's assets to determine what they would actually be worth in a deal. What they found was terrifying. Lehman's commercial real estate holdings were worth far less than the firm claimed. The mortgage-backed securities were nearly worthless. The firm that appeared to have $30 billion in equity might actually be insolvent. The due diligence teams worked around the clock, examining thousands of individual positions. Bank of America sent a team of 50 analysts to Lehman's headquarters, giving them access to detailed files on the firm's largest real estate holdings. What they discovered was systematic overvaluation. Lehman had been carrying properties on its books at values that bore no relationship to current market conditions. One particularly egregious example, Archton, a massive apartment complex investment that Lehman valued at several $1 billion. The Bank of America analysts concluded it was worth perhaps half that amount in the current market. Similar gaps existed across Lehman's commercial real estate portfolio. The firm had been avoiding write-downs, clinging to the belief that real estate values would recover, marking positions at values that couldn't be realized through actual sales. By Thursday, September 11th, it was clear that Lehman Brothers could not survive the weekend without help, and that was when Treasury Secretary Henry Paulson made a decision that would define his legacy. 6 months earlier, when Bear Stearns had been on the verge of collapse, Paulson and the Federal Reserve had arranged a rescue. J.P. Morgan Chase agreed to acquire Bear Stearns, but only with $29 billion in Fed financing to cover Bear's toxic assets. The deal prevented Bear's bankruptcy and stabilized markets, temporarily. The Bear Stearns rescue had been a frantic weekend exercise in crisis management. Bear's CEO, Alan Schwartz, had called Paulson on Thursday, March 13th, saying the firm would run out of cash within hours. The Fed arranged emergency financing to get Bear through Friday, then spent the weekend brokering a sale to J.P. Morgan. The final deal valued Bear at $2 per share. A company that had been worth $70 per share a year earlier was effectively being given away. But it created a problem: moral hazard. If Wall Street firms believed the government would always rescue them from the consequences of reckless risk-taking, what incentive did they have to manage risk responsibly? Paulson was a former Goldman Sachs CEO. He understood how traders thought. He believed someone had to be allowed to fail to prove that bailouts were not automatic. Lehman Brothers would be that example. On Friday, September 12th at 6 p.m., Paulson convened an emergency meeting at the Federal Reserve Bank of New York. Every major Wall Street CEO was summoned: Lloyd Blankfein from Goldman Sachs, Jamie Dimon from J.P. Morgan Chase, John Tain from Merrill Lynch, Vikram Pandit from Citigroup. Dozens of senior executives filled the Fed's conference rooms. The atmosphere in the building was tense from the moment the executives began arriving. Some came directly from their offices, still in business attire. Others had been pulled from dinner plans or weekend preparations. They gathered in clusters in the Fed's marble hallways, trading information and speculation. No one knew exactly what Paulson would say, but everyone understood the severity of the situation. The Federal Reserve Bank of New York occupies an entire city block in Lower Manhattan. The building, completed in 1924, was designed to project strength and permanence. Rusticated limestone blocks, arched windows, architectural details borrowed from Florentine palaces. The vault, 5 stories below street level, holds more gold than any other location on Earth. This was where the American financial system's guardians convened when crisis demanded collective action. Timothy Geithner, president of the New York Fed, had spent the previous 48 hours in constant contact with Lehman's advisors, with potential buyers, with his counterparts at the Federal Reserve Board and the Treasury Department. He had barely slept. His staff had been modeling scenarios, trying to understand what Lehman's bankruptcy would mean for the broader financial system. The models were frightening. Lehman had positions with thousands of counterparties. It was party to more than 900,000 derivative contracts. It held billions of dollars in customer assets. If Lehman filed for bankruptcy, those positions would be frozen, those contracts might be voided, those assets could be locked up for years in bankruptcy court. The ripple effects could be catastrophic. Paulson's message was direct. The government will not provide money to save Lehman Brothers. If you want to prevent a bankruptcy, you need to find a private sector solution. Tonight. The reaction was stunned silence. These were men accustomed to government support when systemically important firms faced trouble. The Fed had rescued Continental Illinois in 1984. It had rescued Long-Term Capital Management in 1998. It had just rescued Bear Stearns in March. The idea that Lehman, far larger than Bear, far more interconnected, would be allowed to fail seemed incomprehensible. Lloyd Blankfein from Goldman Sachs spoke first. He asked whether Paulson fully understood the systemic implications of a Lehman bankruptcy. Goldman itself had billions of dollars in exposure to Lehman. If Lehman failed, Goldman would face immediate losses. But more importantly, the signal to markets would be devastating. If Lehman could fail, any firm could fail. The panic would spread. Paulson held firm. He explained that after the Bear Stearns rescue, he had faced intense political criticism. Conservatives attacked the bailout as inappropriate government intervention. Liberals attacked it as a giveaway to wealthy bankers. Both sides agreed on one thing. If the government was going to rescue every failing institution, the moral hazard problem would become unsustainable. Someone had to be allowed to fail. But Paulson insisted. He and Federal Reserve Bank of New York, President Timothy Geithner, divided the bankers into teams. Some would assess Lehman's assets to determine what was salvageable. Others would discuss forming a consortium to absorb the losses, and everyone understood you have 48 hours. Richard Fuld was not in the building. He remained at Lehman's headquarters on the phone constantly, coordinating with his team, still believing a deal would materialize. He had spoken with Paulson multiple times that week. He believed the government would not allow Lehman to fail. Too many counterparties, too much systemic risk. They had to step in eventually. Fuld spent Friday night in his office on the 31st floor of 745 7th Avenue, surrounded by his most trusted advisors. His general counsel, his chief financial officer, his head of investment banking, all trying to understand what was happening at the Fed building downtown, all trying to formulate responses to scenarios that were evolving minute by minute. The office reflected Fuld's personality, sparse, functional, dominated by computer screens showing market data. There were photographs of his family, but few personal effects. Fuld had never been one for ostentatious displays. His wealth was substantial. He owned homes in Greenwich and Sun Valley. He collected art. But at work he projected intensity and focus, not luxury. The phones rang constantly. Updates from the teams at the Fed building, calls from board members demanding to know what was happening, messages from employees terrified about their jobs. Fuld took each call with the same controlled intensity, gathering information, issuing instructions, refusing to accept that the situation was hopeless. At one point, late Friday night, he placed a call to Warren Buffett. The legendary investor had made billions betting on financial companies during moments of crisis. If Buffett could be convinced to invest in Lehman, it would signal to the market that the firm was fundamentally sound. Fuld's team put together a presentation outlining an investment opportunity. Buffett listened, asked questions, then declined. The price Fuld was proposing didn't account for how bad Lehman's position actually was. Buffett was willing to invest in financial companies. He would later invest $5 billion in Goldman Sachs, but only when the terms adequately compensated him for the risk. Lehman's request didn't meet that standard. Inside the Fed building, the work began. Bank of America and Barclays both had teams examining Lehman's books, trying to value the assets. The numbers were staggering. Lehman's commercial real estate portfolio alone might require $30 billion in write-downs. The mortgage-backed securities were nearly impossible to value because the market for them had disappeared. No one was buying. No one could agree on what they were worth. The due diligence rooms became scenes of controlled chaos. Bankers from different firms, normally fierce competitors, worked alongside each other examining spreadsheets and financial models. Lehman executives tried to present the assets in the best possible light, arguing that current market valuations were temporary dislocations that didn't reflect true economic value. The Bank of America team was skeptical. They had seen this pattern before with Bear Stearns, firms clinging to optimistic valuations long after the market had rendered a different judgment. They built their own models, applying conservative assumptions about recovery rates and liquidation values. The gap between Lehman's marks and Bank of America's estimates was enormous. In a separate conference room, another team was working on what became known as the consortium solution. The idea was that a group of Wall Street banks would collectively purchase Lehman's toxic real estate assets, removing them from the firm's balance sheet so that a buyer could acquire the healthy businesses without taking on the poisonous positions. Each bank would contribute several $billion. The total would be sufficient to absorb the losses. This approach had precedent. In 1998, when long-term capital management faced collapse, the Fed had organized a consortium of banks to inject capital and prevent a disorderly liquidation. The parallel seemed obvious, but there were critical differences. Long-term capital management had been a hedge fund with $4 billion in equity. Lehman was a global investment bank with hundreds of billions in assets and liabilities. The scale was vastly larger. As Friday night became Saturday morning, the shape of the problem crystallized. Lehman had good assets, profitable divisions, valuable businesses that could be sold or integrated into a larger bank, but those assets were buried under a mountain of toxic real estate holdings that someone would have to absorb. Bank of America was interested, but its CEO, Kenneth Lewis, wanted government support similar to what J.P. Morgan had received for Bear Stearns. Paulson refused. Lewis began to waver. Kenneth Lewis had built Bank of America into the largest retail bank in the United States through a series of acquisitions. He understood deal-making. He knew that crisis situations created opportunities to acquire assets at discounted prices. Lehman's brokerage network, its investment banking client relationships, its prime brokerage business serving hedge funds, these were valuable franchises that would significantly enhance Bank of America's position on Wall Street. But Lewis also understood risk. He had seen what happened to banks that made acquisitions during crisis periods without understanding what they were buying. He remembered the 1991 acquisition of Security Pacific by Bank of America, then called Nations Bank, which had initially appeared successful but later revealed hidden problems that took years to resolve. Lewis's team reported back Saturday morning that Lehman's real estate holdings were far worse than publicly disclosed. The potential losses could run to $30 or $40 billion. Without government assistance to absorb those losses, acquiring Lehman could destroy shareholder value for Bank of America. Lewis called Paulson directly. He explained his position. Bank of America was willing to acquire Lehman, but only with the same kind of government support that JP Morgan had received for Bear Stearns, federal financing to cover the toxic assets. Paulson said no. The political environment had changed since March. Congressional leaders were furious about the Bear Stearns bailout. There was no way the administration could justify another government-funded rescue without congressional approval, and there wasn't time to get that approval over a weekend. Lewis thanked Paulson and hung up. Then he called John Thane at Merrill Lynch. Barclays was also interested. The British bank saw an opportunity to acquire Lehman's US operations and establish itself as a major player in American finance. Bob Diamond, Barclays president, drove the negotiations. By Saturday afternoon, Barclays appeared to be the most serious potential buyer. Bob Diamond was an American who had built his career in London, transforming Barclays Capital from a sleepy British investment bank into a serious competitor on the global stage. He was aggressive, confident, and convinced that the financial crisis represented a historic opportunity for Barclays to enter the top tier of global investment banks. Diamond had been studying Lehman for months, even before the crisis reached its climax. He understood the firm's strengths and weaknesses. He knew which businesses were profitable and which were hemorrhaging money, and he believed that if Barclays could acquire Lehman at the right price, it would be transformative. Saturday afternoon, Diamond met with Lehman's senior executives. They walked through the firm's organizational structure, discussing which divisions would fit naturally into Barclays and which might need to be divested. The chemistry was good. Lehman's bankers were desperate for a solution, and Diamond projected confidence that a deal could be done. But there was a problem that wouldn't become clear until Sunday. British law required shareholder approval for an acquisition of this size, and that vote would take 30 to 60 days to organize. Barclays couldn't complete a deal over the weekend, even if all parties agreed to terms. While Lehman's fate hung in the balance, another crisis was simultaneously exploding. American International Group, AIG, one of the largest insurance companies in the world, was collapsing. AIG had sold billions of dollars in credit default swaps, essentially insurance policies on mortgage-backed securities. As those securities plummeted in value, AIG owed money to counterparties across the global financial system, and AIG didn't have the cash to pay. AIG's problems had been building for months, but reached critical mass the same weekend as Lehman. The insurance giant had created a division in London, AIG Financial Products, that sold credit default swaps to banks and investors around the world. These contracts promised to pay out if specified mortgage-backed securities defaulted. AIG collected premiums on these contracts, treating them as essentially free money since the firm's models suggested the securities would never actually default. But the securities were defaulting, and AIG's models had catastrophically underestimated the correlation risk, the possibility that many securities would fail simultaneously during a systemic crisis. Now AIG owed tens of billions of dollars to counterparties, and the firm didn't have the capital to pay. What made AIG's situation even more dangerous than Lehman's was the identity of its counterparties. Goldman Sachs had approximately $20 billion in exposure to AIG. So did many European banks. If AIG failed, these institutions would face immediate, massive losses. The crisis would spread globally within hours. AIG executives arrived at the Fed on Saturday, desperate for help. Geithner and Paulson were now managing two potential catastrophes at once. The weekend that was supposed to solve Lehman had become something far more chaotic. By Saturday night, Bank of America had shifted its focus entirely away from Lehman. Kenneth Lewis had decided to acquire Merrill Lynch instead, another struggling investment bank, but one with fewer toxic assets and a more valuable brand. Merrill's CEO, John Thane, used the weekend to negotiate his own rescue while Lehman's options disappeared. The Merrill Lynch deal came together with remarkable speed. John Thain had been watching the Lehman situation deteriorate and realized that his own firm might be next. Merrill had substantial exposure to mortgage-backed securities. Its stock price was falling. Counterparties were beginning to ask the same nervous questions about Merrill that they were asking about Lehman. Thain called Lewis Saturday afternoon and suggested they talk. Within hours, they had agreed on a basic framework. Bank of America would acquire Merrill Lynch for approximately $50 billion in stock. The deal would be announced Monday morning, simultaneously with whatever happened to Lehman. Merrill's shareholders would receive Bank of America stock, and Merrill Lynch would cease to exist as an independent firm. For Lewis, this was a better outcome than Lehman. Merrill's problems were significant but manageable. The firm's retail brokerage network, thousands of financial advisors serving wealthy clients, was exactly the kind of business Bank of America wanted. And crucially, Merrill didn't have the concentrated commercial real estate exposure that made Lehman so toxic. That left Barclays as the only potential solution. Diamond and his team worked through Saturday night, negotiating terms with Lehman's advisors. The basic structure seemed workable. Barclays would acquire the valuable parts of Lehman, and a consortium of Wall Street banks would absorb the losses on the toxic assets. But Paulson had made one thing clear. The U.S. government would not contribute money to the deal. The banks themselves would have to cover the losses, and the numbers were enormous. Estimates ranged from $30 to $50 billion. Sunday morning arrived. The consortium of banks met to discuss how much each firm would contribute. Goldman Sachs, JP Morgan, Citigroup, Morgan Stanley, every major bank was expected to chip in several $1 billion to cover Lehman's bad assets. The atmosphere was tense. These firms were competitors, and they were being asked to pay for Lehman's mistakes while their own positions were deteriorating. The meeting devolved into acrimony. Some banks argued that those with the largest exposures to Lehman should contribute more, since they would benefit most from preventing a bankruptcy. Others insisted on equal contributions to avoid accusations of self-dealing. Still others questioned whether any amount of money would be sufficient, whether Lehman's problems were simply too large to solve. Jamie Dimon from JP Morgan argued that the banks should contribute, that preventing Lehman's bankruptcy was worth the cost. Others were less certain. The longer they examined Lehman's assets, the worse the numbers looked. Some began to question whether any deal was feasible. Dimon was perhaps the most respected voice in the room. He had successfully navigated JP Morgan through the crisis, had completed the Bear Stearns acquisition, and was known for his risk management discipline. When he spoke, people listened. He argued that a Lehman bankruptcy would trigger cascading failures throughout the financial system, that the interconnections were too dense, that the costs of prevention were far less than the costs of cleaning up afterward. But other CEOs were skeptical. They pointed out that the Bear Stearns rescue had been costly for JP Morgan, despite the government support. They noted that their own firms were under pressure, that their shareholders were suffering losses, that contributing billions to save a competitor might be impossible to justify. Vikram Pandit from Citigroup was particularly reluctant. Citigroup itself was struggling, had significant exposure to mortgage-backed securities, and might need government assistance before long. Contributing several $1 billion to a Lehman rescue would deplete capital that Citi might desperately need in coming months. And then, Sunday afternoon, the final blow arrived. The British Financial Services Authority, the UK regulator, responsible for approving the Barclays deal, informed Paulson and Geithner that it would not approve the acquisition without a shareholder vote. British regulators had watched the American real estate crisis from across the Atlantic. They had no intention of allowing a British bank to import American toxic assets without proper oversight. The call came at approximately 3 p.m. New York time, which was 8 p.m. in London. Callum McCarthy, the head of Britain's Financial Services Authority, spoke with Geithner and explained that British law simply didn't allow for the kind of expedited acquisition that Barclays was proposing. The regulatory framework required shareholder approval for major acquisitions, and that process couldn't be circumvented even in a crisis. Behind this legal explanation lay a deeper political calculation. Alistair Darling, Britain's Chancellor of the Exchequer, had been briefed on the Barclays proposal and was deeply uncomfortable. British banks had their own exposure to troubled mortgage assets. The UK government was not interested in importing America's problems. Alistair Darling, the UK Chancellor of the Exchequer, would later say that he wasn't going to let Britain import America's cancer. The Barclays deal was dead. There was no buyer. There was no consortium solution. There was no government bailout. At 4 p.m. on Sunday, September 14th, Paulson and Geithner concluded that Lehman Brothers could not be saved. Richard Fuld received the news by phone. After everything, after 14 years as CEO, after raising $10 billion in capital over the summer, after believing until the final hours that someone would intervene, it was over. The call came from Harvey Miller, the bankruptcy attorney from Weil, Gotshal and Manges, who had been on standby all weekend in case a filing became necessary. Miller informed Fuld that the board needed to authorize a Chapter 11 bankruptcy filing immediately. Every hour of delay increased the risk of a completely chaotic collapse that would be even more destructive. Fuld's response was reported differently by different people in the room. Some said he simply nodded, accepting the inevitable. Others said he became emotional, that his voice broke as he tried to process what was happening. What everyone agreed on was that the moment was devastating. Fuld had dedicated his entire adult life to Lehman Brothers, and now he was presiding over its death. Sunday evening, Lehman's board of directors authorized the filing for bankruptcy. Lawyers worked through the night preparing the paperwork. At 1:45 a.m. on Monday, September 15, 2008, Lehman Brothers Holdings, Inc. filed for Chapter 11 bankruptcy protection in the United States Bankruptcy Court for the Southern District of New York. The filing listed $639 billion in assets and $613 billion in debts. It was the largest bankruptcy in American history, dwarfing the previous record, WorldCom's $104 billion filing in 2002. The bankruptcy petition ran hundreds of pages. It detailed Lehman's corporate structure, dozens of subsidiaries and affiliated entities spread across the globe. It listed the firm's largest creditors, Japanese banks, European financial institutions, American money market funds. It described assets that ranged from office buildings in Manhattan to mortgage-backed securities to derivatives contracts with thousands of counterparties. Harvey Miller and his team had been preparing for this possibility for weeks, building the legal infrastructure that would be necessary to manage what would inevitably be one of the most complex bankruptcies in history. They had identified which subsidiaries would need to file, which could be kept operating, how to preserve whatever value remained in Lehman's businesses. But no amount of preparation could make the moment less surreal. Lehman Brothers, an institution that had survived the Civil War, the Great Depression, world wars, and countless market panics, was ceasing to exist. The bankruptcy filing would trigger a process that would take years to resolve, that would ultimately recover only a fraction of what creditors were owed, that would destroy billions in value. 25,000 Lehman employees learned they had lost their jobs by watching television. The New York headquarters building at 745 7th Avenue became a media spectacle as cameras filmed workers leaving with cardboard boxes. Some cried, others looked numb. They had believed until the end that something would save them. The scenes outside Lehman's headquarters Monday morning became iconic images of the financial crisis. Photographers captured employees in business attire carrying boxes containing their personal belongings. Some stopped to talk with reporters, expressing shock and anger. Others kept their heads down, trying to maintain dignity in a humiliating situation. Jennifer Park, who had worked in Lehman's Human Resources Department for 12 years, stood on 7th Avenue holding a box containing photographs of her children, a coffee mug her team had given her as a birthday gift, and a small plant she had kept on her desk. A reporter asked her how she felt. "I don't understand," she said. "We were told Friday that they were working on solutions. We were told to come in Monday and everything would be sorted out. I have a mortgage. I have kids in school. What am I supposed to do?" The reporter had no answer. Across the financial district, similar scenes were playing out. Lehman employees who had believed themselves part of a permanent institution discovered that nothing was permanent, that careers could evaporate over a weekend, that the stability they had counted on was illusory. Financial markets opened Monday morning in chaos. The Dow Jones Industrial Average fell 504 points, a 4.4% decline. But that was just the beginning. Lehman Brothers had been counterparty to thousands of trades with financial institutions around the world. It owed money to banks, hedge funds, pension funds, corporations, and those entities had counted on receiving that money to meet their own obligations. When Lehman filed for bankruptcy, those payments stopped. Credit markets froze. Banks stopped lending to each other because no one knew who else might fail. The practical implications were immediate and devastating. A hedge fund that had cash deposited with Lehman couldn't access that money. It was frozen by the bankruptcy. A corporation that had bought derivatives from Lehman to hedge currency exposure suddenly found those contracts in limbo. A pension fund that owned Lehman bonds discovered they were worthless. But the psychological impact was perhaps even more important. For decades, financial institutions had operated on the assumption that systemically important firms would be rescued if they faced failure. Lehman's bankruptcy shattered that assumption. If Lehman could fail, anyone could fail. Every institution became suspect. The LIBOR-OIS spread, a measure of stress in short-term lending markets, spiked to levels never before recorded. Banks were hoarding cash, refusing to lend even overnight. The global financial system was seizing. LIBOR, the London interbank offered rate, measures the interest rate at which banks lend to each other. The OIS, overnight index, swap rate, reflects expectations for central bank rates. The spread between them indicates how much extra interest banks demand to compensate for credit risk when lending to other banks. Normally, this spread is minimal, just a few basis points, reflecting the assumption that major banks are safe counterparties. After Lehman's bankruptcy, the spread exploded to more than 300 basis points. Banks were demanding 3% additional interest to lend to each other overnight. This meant that credit risk had gone from negligible to severe essentially instantly. The plumbing of the financial system, the routine overnight lending that allows banks to manage their cash positions, had stopped functioning. And then, on Tuesday, September 16th, the government did exactly what Paulson had said it wouldn't do. It bailed out AIG. The Federal Reserve provided $85 billion to prevent AIG's collapse, effectively nationalizing the insurance giant. The inconsistency was staggering. Lehman was allowed to fail. AIG was saved. The justification was that AIG had better collateral. Its insurance subsidiaries were state-regulated entities with real assets. Lehman was a pure investment bank with toxic securities. But to observers, the distinction seemed arbitrary. And critics noted that Goldman Sachs, Paulson's former firm, was a major AIG counterparty that would have faced enormous losses if AIG failed. The optics were terrible. Paulson had spent the weekend insisting that moral hazard required letting Lehman fail, that unlimited bailouts were unsustainable. And then, 48 hours later, the government rescued AIG with taxpayer money. The inconsistency suggested either that the moral hazard argument had been pretextual, or that officials hadn't actually understood the systemic consequences of their decisions. Paulson and Geithner defended the distinction. They argued that AIG truly had assets that could collateralize a government loan, whereas Lehman was insolvent, and any rescue would have been a pure equity injection with taxpayer money. They noted that AIG's failure would have triggered immediate, catastrophic losses for dozens of institutions, whereas Lehman's bankruptcy could at least be managed through an orderly legal process. But critics pointed out that the consequences of Lehman's bankruptcy were turning out to be far worse than officials had anticipated. If the systemic damage was so severe, perhaps the moral hazard argument should have been set aside. Better to rescue Lehman and deal with the incentive problems later than to trigger a global financial crisis. The decision to save AIG while letting Lehman fail would be debated for years. But in the moment, the immediate consequence was clear. The financial crisis had entered a new, more terrifying phase. On Wednesday, September 17th, the Reserve Primary Fund, one of the oldest and most respected money market funds, announced that it could no longer maintain its share price at $1. It had invested heavily in Lehman commercial paper, which was now worthless. The fund broke the buck, falling to 97 cents per share. This was unprecedented. Money market funds were supposed to be as safe as bank deposits. Breaking the buck meant that even the safest investments outside of FDIC-insured bank accounts were at risk. Investors panicked. Within days, hundreds of billions of dollars flowed out of money market funds as investors fled to safety. The Reserve Primary Fund had been founded in 1970 as one of the first money market mutual funds, offering investors a way to earn slightly higher interest than bank savings accounts while maintaining what was supposed to be absolute safety. The fund structure was simple. It invested in ultra-safe, short-term securities like treasury bills, bank certificates of deposit, and highly rated commercial paper. The net asset value was supposed to always remain at exactly $1 per share. Bruce Bent, who had founded the Reserve Primary Fund, was a respected figure in the money market industry. He had helped pioneer the entire category of money market funds. When his fund announced that it had broken the buck, that the value had fallen below $1 per share, it shattered a fundamental assumption that investors had held for nearly 4 decades. The immediate cause was straightforward. The Reserve Primary Fund had owned $785 million in Lehman Brothers commercial paper. When Lehman filed for bankruptcy, that paper became worthless overnight. The fund's total assets were $65 billion, so the Lehman holdings represented about 1.2% of the portfolio. Under normal circumstances, a 1% loss would be unfortunate, but manageable. But money market funds operate on the assumption of absolute stability. Investors treat them as equivalent to cash. When the Reserve Primary Fund announced its net asset value had fallen to 97 cents, investors realized that money market funds weren't actually as safe as bank deposits, and they reacted by withdrawing their money as fast as possible. Credit markets were now completely frozen. Corporations couldn't borrow to meet payroll. Cities couldn't issue bonds to fund operations. The entire mechanism by which credit flowed through the global economy had stopped functioning. General Electric, one of America's largest and most creditworthy corporations, found itself unable to borrow money in the commercial paper market. GE relied on short-term borrowing to manage cash flow across its sprawling industrial and financial operations. When the commercial paper market froze, GE faced the prospect of being unable to meet routine obligations despite being fundamentally profitable. Municipalities across America faced similar problems. Cities and states rely on short-term borrowing to manage timing mismatches between when tax revenues arrive and when expenses must be paid. When credit markets froze, even entities with strong credit ratings couldn't borrow. Some municipalities faced the prospect of being unable to meet payroll for teachers, police officers, and other public employees. The crisis had spread from investment banks to the real economy with frightening speed. On September 29th, the U.S. House of Representatives voted down the Troubled Asset Relief Program, TARP, a $700 billion bailout package proposed by Paulson to purchase toxic assets from banks. The Dow Jones fell 778 points that day, the largest single-day point decline in history at that time. The TARP vote was extraordinary political theatre. Paulson and Federal Reserve Chairman Ben Bernanke had appeared before Congress to warn that without immediate action, the entire financial system could collapse. Bernanke, normally reserved and academic in his presentations, was reportedly blunt. If Congress didn't act, there might not be an economy on Monday. But members of Congress faced intense pressure from constituents who were furious about bailouts. The idea of using taxpayer money to rescue Wall Street banks that had made reckless bets offended people across the political spectrum. Conservative Republicans opposed government intervention in markets. Progressive Democrats opposed rewarding the wealthy executives whose decisions had caused the crisis. When the vote was called, the bill failed 228 to 205. Stock markets collapsed. The Dow's 778-point decline wiped out more than $1 trillion in market value. Congressional phone lines were overwhelmed with constituents calling to express opinions, some angry that the bill had been voted down, others furious that it had even been proposed. The House reconsidered and passed TARP on October 3rd, but by then the damage was done. The United States had entered what would later be designated the Great Recession, the worst economic downturn since the Great Depression of the 1930s. Over the following months, the crisis spread globally. Iceland's banking system collapsed. Ireland nationalised its major banks. The United Kingdom nearly lost Royal Bank of Scotland and had to rescue Lloyds Banking Group. European governments injected hundreds of billions of euros into their financial systems. China implemented a massive stimulus program. The crisis that began in American subprime mortgages had become a global catastrophe. Iceland's collapse was particularly dramatic. The country's three major banks, Kaupthing, Landsbanki, and Glitnir, had expanded aggressively in the years before the crisis, accumulating assets that totaled more than 10 times Iceland's gross domestic product. When global credit markets froze, these banks couldn't refinance their debts. All three failed within a single week in October 2008. Iceland's government was forced to seek emergency assistance from the International Monetary Fund. The country's currency plummeted. Citizens who had deposits in the failed banks discovered their savings were gone. Ireland faced a different but equally severe crisis. Irish banks had fueled a spectacular real estate bubble, lending aggressively against property values that bore no relation to economic fundamentals. When the bubble burst, the banks faced insolvency. The Irish government made a fateful decision. It guaranteed all deposits and debts of the major banks, effectively backing hundreds of billions of euros in liabilities. This prevented an immediate banking collapse but transferred the crisis from the private sector to the sovereign, ultimately requiring an international bailout. The United Kingdom's crisis centred on Royal Bank of Scotland, which had completed the largest bank acquisition in history, the purchase of Dutch bank ABN AMRO in 2007, just as the crisis was beginning. The timing couldn't have been worse. RBS found itself massively over-leveraged, with enormous exposure to deteriorating assets. The British government was forced to inject tens of billions of pounds in capital, effectively nationalising the bank. Unemployment in the United States rose from 6.1% in September 2008 to 10% by October 2009. Millions lost their homes to foreclosure. Retirement accounts evaporated. The wealth destruction was staggering. Global stock markets lost approximately $10 trillion in value in October 2008 alone. The human costs were devastating. The unemployment statistics represented millions of individual tragedies, people who lost jobs they'd held for decades, who exhausted their savings, who faced foreclosure and bankruptcy. The crisis destroyed retirement plans, college funds, the accumulated wealth of a lifetime. Detroit was particularly hard hit. The city's automobile industry, already struggling with foreign competition, nearly collapsed entirely. General Motors and Chrysler would eventually require government bailouts. Thousands of auto workers lost their jobs. The unemployment rate in some Michigan counties exceeded 20%. Phoenix, Las Vegas, and cities across Florida and California that had experienced the most extreme housing bubbles saw foreclosure rates that were almost incomprehensible. In some neighborhoods, half the homes were either in foreclosure or owned by banks that had repossessed them. Property values fell 50, 60, 70% from their peak. Homeowners who had been convinced their homes were their most valuable assets discovered they were underwater, owing more on their mortgages than their properties were worth. The crisis didn't just destroy wealth, it destroyed confidence, the sense that hard work and responsible behavior would lead to security. People who had followed all the rules, who had saved diligently and avoided excessive debt, found themselves suffering because of decisions made by financial executives they'd never heard of at institutions they didn't understand. And at the center of the narrative was a single question that had never been adequately answered. Could Lehman Brothers have been saved? Henry Paulson insisted that the government lacked legal authority to rescue Lehman without a buyer. The Federal Reserve could only lend against good collateral, and Lehman didn't have enough. Unlike with Bear Stearns, there was no willing acquirer to facilitate a government-backed merger. Unlike with AIG, there were no insurance subsidiaries to provide collateral for a loan. Timothy Geithner supported this account. In his memoir, he wrote that they had explored every possible option and concluded that Lehman's insolvency was too severe. The firm was unsavable. Richard Fuld disagreed violently. In testimony before Congress in October 2008, he argued that he had been sandbagged, that the government had led him to believe they would intervene, then changed their minds at the last moment. He pointed to the AIG bailout as proof that the government could have saved Lehman if it wanted to. Fuld's congressional testimony was painful to watch. He appeared diminished, his characteristic intensity replaced by something closer to bewilderment. He described the phone calls with Paulson, the assurances he believed he had received, the expectation that if Lehman could just survive until Monday, a solution would be found. Members of Congress were not sympathetic. Representative Henry Waxman asked Fuld about the nearly $500 million in compensation he had received since 2000. Fuld disputed the figure, claiming that much of his compensation had been in Lehman's stock that was now worthless, that he had lost more than anyone. The exchange highlighted a disconnect that would define public perception of the crisis. Executives who had made fortunes during the boom trying to position themselves as victims of the bust. But the most systematic challenge to the official narrative came years later, in 2018, when economist Lawrence Ball published a detailed analysis titled The Fed and Lehman Brothers, Setting the Record Straight on a Financial Disaster. Ball, a Johns Hopkins University professor, examined the legal authorities available to the Federal Reserve and concluded that the Fed did have the power to rescue Lehman. Section 13(3) of the Federal Reserve Act allowed the Fed to lend to any entity in unusual and exigent circumstances. The Fed had used this authority to support Bear Stearns and would use it for AIG 2 days after Lehman failed. Ball argued that the Fed chose not to use it for Lehman, not because it couldn't, but because officials decided that allowing a failure would send an important message about moral hazard. Ball's research involved meticulous examination of Federal Reserve documents, internal memos, and the legal framework governing emergency lending. He interviewed former officials and analyzed the collateral that Lehman had available. His conclusion was unambiguous. The Fed's claim that it lacked legal authority to rescue Lehman was false. The authority existed. Officials chose not to use it. This conclusion was controversial. It suggested that the worst financial crisis in 80 years might have resulted not from an unavoidable catastrophe, but from a policy choice. Officials had decided to let Lehman fail to teach Wall Street a lesson about moral hazard, and that lesson had triggered a global disaster. Ball's research suggested that Paulson and Geithner had constructed a post hoc justification for a decision that was fundamentally political rather than legal. They wanted to demonstrate that not every firm would be rescued. Lehman was the sacrifice. The official response to Ball's work was measured. Former officials noted that even if legal authority existed, rescuing Lehman might have required such massive support that it would have been politically untenable before the crisis fully materialized. And they pointed out that Lehman's balance sheet was fundamentally worse than Bear Stearns had been. The losses were deeper, the toxic assets more concentrated. But Ball's analysis raised a troubling possibility that the worst financial crisis in 80 years might have been prevented or at least mitigated if different decisions had been made during that September weekend. There is another layer to the story that complicates any simple narrative of government failure or Wall Street recklessness. It is the story of what Lehman Brothers did to itself in the years before the crisis. The Valukas report, a 2,200-page examination conducted by bankruptcy examiner Anton Valukas and released in 2010, documented the internal practices that had made Lehman so fragile. Repo 105, the accounting technique that temporarily removed assets from the balance sheet, had been used to deceive investors about the firm's true leverage. Lehman's chief financial officer had testified that the technique was appropriate, but internal emails revealed that executives knew it was being used to manipulate the firm's public financial position. The emails were damning. One exchange from 2008 showed Lehman's global financial controller expressing concern that Repo 105 was being used for window dressing purposes to make the firm's leverage appear lower than it actually was. Another email discussed the importance of timing these transactions to coincide with quarter-end reporting dates to maximize the cosmetic impact on financial statements. Ernst & Young, Lehman's auditor, had been aware of Repo 105 and had not objected. The report suggested this constituted a serious failure of professional responsibility. Ernst & Young paid $450 million to settle claims related to its Lehman audit, but admitted no wrongdoing. The relationship between Lehman and Ernst & Young exemplified broader problems with the auditing industry. Auditors are supposed to provide independent verification of a company's financial statements, serving as a check on management's incentives to present optimistic pictures. But auditors are paid by the companies they audit, creating a fundamental conflict of interest. Firms that raise too many objections risk losing clients to more accommodating competitors. Ernst & Young had audited Lehman for decades. The relationship was close, collaborative, profitable for the accounting firm. When Ernst & Young's auditors saw Lehman using Repo 105 to temporarily reduce reported leverage at quarter end, they could have objected, could have insisted on disclosure, could have qualified their audit opinion. Instead, they accepted management's explanations and signed off on financial statements that didn't fully reflect Lehman's actual risk position. The report also documented a culture where dissent was punished. Madeline Antonsick, Lehman's chief risk officer, had raised concerns about the firm's real estate exposure in 2006 and 2007. She had warned that Lehman was taking on excessive risk. She was marginalized and ultimately pushed out of the firm in 2007. Antonsick's experience illustrated the broader cultural problems at Lehman. As chief risk officer, her job was specifically to identify and communicate risks that could threaten the firm. She had extensive experience in risk management, having held senior positions at Goldman Sachs before joining Lehman. She understood how to analyze complex portfolios and stress test positions against adverse scenarios. In 2006, she began warning senior management that Lehman's commercial real estate exposure was growing too large, too concentrated, too dependent on optimistic assumptions about continuing price appreciation. She presented data showing that if real estate prices declined even modestly, Lehman's positions would incur substantial losses. She recommended reducing exposure, increasing capital buffers, diversifying risk. Her warnings were dismissed. The commercial real estate business was enormously profitable. The traders and bankers running those businesses were Fuld's favorites, his trusted lieutenants. When forced to choose between the chief risk officer, urging caution, and the business heads generating billions in revenue, Fuld chose the latter. Antoncic found herself excluded from key meetings, her recommendations ignored, her authority undermined. By mid-2007, her position had become untenable. She left the firm, one of several senior risk managers who departed during the period when their expertise was most needed. Others who questioned the firm's direction faced similar treatment. Lehman's culture rewarded revenue generation and punished risk management. The traders who made aggressive bets were celebrated. The risk officers who urged caution were ignored. Richard Fuld, at the center of this culture, appeared to genuinely believe that Lehman's strategy was sound. He had rejected multiple opportunities to sell the firm or raise capital on terms he considered inadequate. In early 2008, he had rejected an offer from Korea Development Bank because the proposed investment valued Lehman too low. He believed the firm was worth more and that the market would eventually recognize that. This was not cynical fraud. This was self-deception on a massive scale. Fuld had spent his entire career at Lehman. The firm was his identity. Accepting that it might be fatally flawed would have required accepting that his life's work had been a failure. The psychological barriers to that recognition were immense, and so he continued to believe, past the point where belief was rational, that Lehman would survive. Even on Sunday, September 14th, hours before the bankruptcy filing, Fuld was reportedly still convinced that a deal would emerge. The compensation figures are stark. Between 2000 and 2007, Richard Fuld received approximately $484 million in compensation. Much of this was in Lehman stock, which became worthless when the firm collapsed. But he had sold enough shares over the years to accumulate substantial wealth. During his congressional testimony, Fuld disputed the compensation figures and insisted he had lost far more than he had gained. He became emotional describing what Lehman's failure meant to him personally, but the image that remained in public consciousness was of a CEO who had made hundreds of millions while leading his firm to catastrophe. No senior Lehman executive was ever charged with a crime. The Valukas report found evidence of possible negligence and poor judgment, but concluded that proving criminal intent would be extremely difficult. The accounting manipulations, while deceptive, had been technically legal. The excessive risk-taking had been authorized by the board of directors. The firm's collapse was the result of systemic failures, not actions that met the legal definition of fraud. This outcome frustrated many who believed that someone should be held accountable. The financial crisis destroyed millions of lives. People lost their homes, their savings, their jobs, and the executives responsible faced no criminal consequences. The government did pursue civil cases. The SEC charged several Lehman executives with securities fraud related to the Repo 105 disclosures. These cases were settled for financial penalties, but no admission of guilt. The amounts paid were tiny compared to the destruction caused. Richard Fuld largely disappeared from public view after the bankruptcy. He testified before Congress, endured harsh questioning, then retreated. In 2016, he re-emerged to start a hedge fund called Matrix Advisors. The announcement was met with disbelief. The man who had led the largest bankruptcy in history was returning to manage money. But the fund was small, operated quietly, and attracted little attention. Fuld rarely speaks publicly. When he does, he maintains that Lehman was a victim of circumstances beyond its control, a liquidity crisis, a panic, a government that changed its mind about supporting the financial system. He does not accept that Lehman's risk-taking was fundamentally different from its competitors or that his leadership was responsible for the firm's collapse. And in a narrow sense, he has a point. Lehman's practices were not unique. Every major investment bank had loaded up on mortgage-backed securities. Every firm was highly leveraged. Every firm had aggressive traders and marginalized risk officers. The difference was that some firms survived and some didn't. And the line between survival and failure often came down to timing, luck, and access to government support. Bear Stearns failed in March but was rescued by a government-backed merger. Lehman failed in September and was allowed to collapse. Merrill Lynch was acquired by Bank of America the same weekend Lehman died. AIG received a bailout. Goldman Sachs and Morgan Stanley converted to bank holding companies, giving them access to Federal Reserve support. Citigroup received massive government assistance. Lehman's collapse was not solely the result of being worse than its competitors. It was partly the result of being in the wrong place at the wrong moment, when officials decided that an example needed to be made. But acknowledging this doesn't absolve Lehman's management. The firm's leverage was extreme, even by industry standards. Its real estate concentration was unusual, and Richard Fuld's refusal to accept offers that might have saved the firm in early 2008 eliminated options that might have prevented the September catastrophe. The intersection of institutional failure, regulatory failure, and individual failure created the conditions for disaster. Lehman built the bomb, regulators failed to defuse it, and government officials made the choice to let it explode. Believing the damage could be contained, they were wrong about the containment. The explosion was far worse than anyone anticipated, and the consequences reshaped the global economy. The immediate regulatory response was the Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in July 2010. The legislation ran more than 2,000 pages and represented the most significant expansion of financial regulation since the Great Depression. Key provisions included the Volcker Rule, which restricted proprietary trading by banks, the creation of the Consumer Financial Protection Bureau, new capital requirements for systemically important financial institutions, and the establishment of an orderly liquidation authority designed to allow the government to wind down failing financial firms without either a disruptive bankruptcy or a taxpayer bailout. The law was controversial. Banks argued it would restrict their ability to serve clients and reduce American competitiveness. Progressives argued it didn't go far enough, that it allowed too many loopholes and failed to break up the largest banks. The political compromises required to pass the legislation meant that implementation would be complex and contested. More than a decade after Dodd-Frank's passage, debate continues about its effectiveness. The largest banks have become even larger. JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup now control assets far exceeding what they held in 2008. Supporters argue this reflects greater safety through higher capital requirements. Critics argue it proves that too big to fail remains entrenched. Internationally, the crisis led to the Basel III framework, a set of global banking regulations designed to strengthen capital requirements and improve risk management. Central banks around the world adopted new tools for responding to financial crises, including quantitative easing, large-scale asset purchases designed to inject liquidity into frozen markets. The political consequences were equally profound. The bank bailouts necessary to prevent complete economic collapse created enormous public anger. The Occupy Wall Street movement emerged in 2011, focused on wealth inequality and corporate power. The Tea Party movement on the right also channeled anti-bailout sentiment into opposition to government spending and intervention. This anger reshaped democratic politics across the developed world. Trust in institutions declined, populist movements gained strength. The crisis created political conditions that would eventually contribute to outcomes like Brexit and the 2016 US presidential election. And Lehman moment entered the lexicon as shorthand for systemic collapse. When European sovereign debt crises threatened in 2011 and 2012, observers warned against creating another Lehman moment. When COVID-19 struck in 2020 and markets seized, central banks moved immediately to provide unlimited liquidity, explicitly referencing the lesson of Lehman, that allowing a systemic institution to fail triggers cascading disasters. The interesting question is whether that lesson is correct. Some economists argue that Lehman's bankruptcy, while disruptive, ultimately allowed necessary deleveraging and restructuring to occur. They suggest that if every failing institution is rescued, the problems that led to crisis are never actually resolved. They are simply postponed to a future, potentially worse, collapse. This perspective comes primarily from market-oriented economists who believe that creative destruction, the process by which inefficient or poorly managed institutions fail and are replaced by better alternatives, is essential to capitalism's long-term health. They point out that Japan's experience in the 1990s, when the government propped up failing banks rather than allowing them to collapse, led to a lost decade of economic stagnation. By that logic, allowing Lehman to fail, while painful in the short term, prevented the accumulation of zombie institutions that would have dragged down the economy for years. The counter-argument emphasizes scale and interconnectedness. Japan's banking crisis was primarily domestic. Lehman's collapse was global, instantaneous, and transmitted through countless derivative contracts and counterparty relationships that regulators didn't fully understand. The financial system in 2008 was fundamentally different from any previous era, more concentrated, more leveraged, more dependent on moment-to-moment confidence in the solvency of major institutions. Others insist that Lehman proved the opposite, that in a highly interconnected financial system, certain failures cannot be tolerated because the costs are too enormous. The right approach in this view is aggressive regulation to prevent institutions from becoming so large and interconnected that their failure would be catastrophic. This camp argues that the lesson of Lehman is not let failures happen, but rather don't allow institutions to become so systemically important that their failure is catastrophic. They advocate for breaking up the largest banks, imposing strict limits on leverage, separating commercial banking from investment banking, and creating robust resolution mechanisms that allow regulators to wind down failing institutions without triggering panic. This debate reflects a deeper tension that the financial crisis exposed but didn't resolve. The relationship between markets and government, between private risk-taking and public consequences, between the efficiency of allowing failure and the stability of preventing it. Lehman Brothers existed for 158 years. It survived the Civil War by maintaining connections in both North and South. It survived the Depression by managing risk conservatively and maintaining client trust. It survived the crises of the 1970s and 1980s through adaptation and partnership, but it could not survive its own final decade. The firm that emerged from the American Express spin-off in 1994 was fundamentally different from the Lehman Brothers that had endured for the previous century and a half. The culture of risk management gave way to a culture of risk-taking. The long-term perspective gave way to quarterly earnings pressures. The partnership ethos gave way to public company incentives. Richard Fuld bears enormous responsibility for this transformation, but he operated within a broader system that rewarded exactly the behaviors Lehman exhibited. Every investment bank was competing for the same business. Every firm faced pressure to maximize returns. Every CEO knew that firms which didn't generate sufficient profits would see their stock price decline and face activist shareholder pressure. The mortgage-backed securities business seemed to offer a way to generate enormous profits with apparently limited risk. The rating agencies certified the securities as safe. The regulators didn't object. The market demanded more. Lehman supplied it. And when the underlying assumptions proved false, when housing prices didn't perpetually rise, when defaults weren't contained, when securities couldn't be valued, the entire structure collapsed. The weekend in September 2008 was the endgame of choices made years earlier. By the time Paulson and Geithner were meeting with Wall Street CEOs at the Federal Reserve Bank of New York, Lehman's fate was largely sealed. The question wasn't really whether the firm could be saved, but whether its collapse could be managed. And the answer was no, the collapse could not be managed. The interconnections were too dense, the obligations too large, the panic too severe. Lehman's bankruptcy triggered exactly the systemic crisis that Too Big to Fail was supposed to prevent. Yet the government's response to that crisis, TARP, the AIG bailout, the Fed's unlimited liquidity support, ultimately worked. Markets stabilized by early 2009, banks recapitalized, credit began flowing again. The economy didn't collapse into a second Great Depression. This created a perverse outcome. The crisis was severe enough to cause enormous harm, but not severe enough to force fundamental restructuring of the financial system. The largest banks received government support, survived, and returned to profitability. Many of the practices that contributed to the crisis, high leverage, complex derivatives, short-term funding of long-term assets, resumed within a few years. The Lehman Bankruptcy Examiner's report runs 2,200 pages. Congressional investigations produce thousands more pages of testimony and analysis. Academic studies continue to examine every aspect of the crisis. And yet fundamental questions remain unresolved. Was Lehman's failure necessary to establish that moral hazard had limits, or was it a catastrophic policy error? Could the Fed legally have rescued Lehman, or were Paulson and Geithner correct that they lacked authority? Did the British regulators who blocked the Barclays deal understand the consequences, or were they protecting Britain from America's crisis without considering the global implications? These questions matter because the next crisis is inevitable. Financial systems are inherently unstable. Asset prices rise beyond sustainable levels. Leverage accumulates. Risk is underestimated. And eventually something breaks. The question is whether the institutions responsible for managing that break, central banks, treasuries, regulatory agencies, will make better decisions than their predecessors did in September 2008. The evidence is mixed. Regulators are more alert to systemic risk. Banks hold more capital. Stress testing has become routine. But the fundamental dynamics, the competition for profits, the pressure to take risk, the difficulty of valuing complex securities remain. And the political tolerance for bailouts has declined. The public anger that followed TARP hasn't disappeared. The next time a major financial institution fails, officials will face enormous pressure to let it collapse rather than rescue it with public money. But they will also know what happened when Lehman was allowed to fail. This tension between the political costs of intervention and the economic costs of non-intervention remains unresolved. Standing in front of the Federal Reserve Bank of New York today, you can imagine that September weekend. The building still stands at 33 Liberty Street, a limestone fortress that looks designed to survive catastrophe. Inside these walls, some of the most powerful people in global finance gathered to prevent disaster. They failed. But what's remarkable, looking back, is how contingent the outcome was. If the British regulators had approved the Barclays deal, Lehman might have survived. If Bank of America had chosen Lehman instead of Merrill Lynch, the crisis might have taken a different form. If Paulson had authorized a government backstop, the bankruptcy might have been avoided. Alternatively, if Lehman had failed weeks earlier, before the political groundwork for TARP had been laid, the crisis might have been even worse. If the Fed hadn't moved aggressively after Lehman's collapse, the financial system might have completely frozen. The weekend broke the world not because Lehman's failure was uniquely catastrophic, but because it occurred at precisely the moment when the financial system was most fragile and when the government was least prepared to respond. Henry Lehman opened his dry goods store in Montgomery in 1844 with no grand vision. He was trying to make a living. When his brothers joined him and they began trading cotton, they were opportunists, not architects of a financial empire. When they survived the Civil War and expanded into New York, they were adapting to circumstances, not executing a master plan. The firm that bore their name became something they could never have imagined, a global investment bank with hundreds of billions in assets, operations in dozens of countries, complex derivatives portfolios, and dependencies throughout the financial system. And when that firm collapsed 158 years after Henry Lehman opened his shop, it happened because the people running it had forgotten the lessons that had allowed it to survive for so long. They had forgotten that market cycle. They had forgotten that leverage is dangerous. They had forgotten that risk cannot be eliminated, only transferred. Richard Fuld learned these lessons too late. On September 15, 2008, standing in Lehman's headquarters as the bankruptcy became reality, he reportedly told colleagues that he couldn't understand how this had happened. The firm had been strong, the strategy had been sound, the government should have intervened, but the firm hadn't been strong, the strategy had been fatally flawed, and the government had decided that intervention would create worse problems than it solved. 25,000 people lost their jobs that day. Millions more lost their homes, their savings, their security over the following months. The crisis that Lehman's collapse accelerated destroyed trillions of dollars in wealth and took years to overcome. And at the center of it all was a question that no one answered satisfactorily during that desperate September weekend. In a financial system where everyone is connected to everyone else, where the failure of one institution can cascade through the entire network, who decides which institutions must be saved and which can be allowed to die? Henry Paulson decided that Lehman could die. He believed the system could absorb the shock. He was wrong, but he was also right that unlimited bailouts create unlimited moral hazard. The tension between these realities remains. The building at 745 7th Avenue no longer houses Lehman Brothers. The name disappeared. The firm was carved up in bankruptcy. Barclays acquired the U.S. investment banking operations. Nomura bought the Asian and European businesses. The pieces were sold to whoever would take them. But the question Lehman's collapse posed lives on. It resurfaces every time a major institution faces failure. Should governments rescue failing firms or let them collapse? Is the moral hazard of bailouts worse than the economic damage of bankruptcy? Can systemic risk be managed or only postponed? These questions have no permanent answers. Each crisis presents them anew. Each generation of policymakers must decide how to respond when the next Lehman Brothers stands on the edge of collapse. What we know is this: the decision to let Lehman fail triggered the worst financial crisis since the Great Depression. But rescuing every failing institution would have created different, possibly worse, problems. The challenge is finding the wisdom to distinguish between failures that must be prevented and failures that must be allowed. That weekend in September 2008, that wisdom was not found, and the price was paid by millions who had nothing to do with the decisions that created the crisis, but everything to do with the consequences of those decisions. The trading floor is still silent, not because Lehman Brothers is gone, that is just history, but because the question that Lehman's collapse posed remains unanswered. And until it is answered, the risk of another Lehman moment persists, waiting for the next time that leverage accumulates, risk is underestimated, and the people responsible for preventing catastrophe must decide whether to intervene or let nature take its course. Henry Lehman would not recognize the firm that bore his name in 2008, and he would not recognize the world that firm's collapse helped create. But he would understand the fundamental lesson that his successors forgot, that survival requires humility, that markets are not infinite, and that institutions built on unsustainable foundations will eventually fall, no matter how large or important they believed themselves to be. The weekend that broke the world was not an accident. It was the inevitable conclusion of choices made over years. Lehman Brothers built itself into something too large to fail and too broken to save. And when the moment of truth arrived, everyone discovered that the assumptions undergirding the entire financial system were false. That discovery changed everything. The crisis revealed that the sophisticated models banks used to measure risk had catastrophically underestimated correlation, the possibility that many things would go wrong simultaneously. The assumption that housing prices wouldn't decline nationwide was exposed as fantasy. The belief that complex financial instruments had distributed risk efficiently was proven false. They had merely obscured it, concentrated it, and amplified it. The weekend also revealed the limits of individual decision-making in crisis. Paulson, Geithner, and the assembled CEOs were intelligent, experienced people trying to prevent catastrophe, but they were operating with incomplete information, under extreme time pressure, constrained by legal and political realities they only partially controlled. The narrative that emerges from examining that weekend is not one of villains and heroes, but of human beings making choices with imperfect knowledge and discovering only afterward just how wrong they had been. And we are still living with the consequences.